The US stock market opened a new trading week, extending the same trend of the last week. The hawkish rhetoric of the central banks dampens their risk-on mood. Besides, investors are anticipating crucial US inflation data and the results of the bank test. Wall Street opened on Monday on a pessimistic note, and some investors took a wait-and-see approach. The market saw a new sell-off, thus pushing the benchmark stock indexes down. The major stock indexes closed deep in the red. The Nasdaq logged the worst performance. The Dow Jones edged down by 12 points, or 0.04%. The Nasdaq sank by 1.16%. The S&P 500 shed 19 points, or 0.45%. to close at 4,328 points. The top stock indexes are poised to open the New York trade higher. However, the red-hot economic data subdued optimism and the indexes went in the opposite directions. Futures on the stock indexes traded mixed in the New York pre-market. The S&P 500 is expected to trade in the intraday corridor between 4,300 and 4,370 points. US stocks closed lower on a Monday as investors pulled back on a risk and the mega-cap companies compounded losses. Shares of Meta, Alphabet and Tesla became leaders of the fall. In particular, Alphabet shares fell by 3.3% after UBS downgraded the stock to neutral. Tesla shares lost as much as 6% after Goldman Sachs downgraded the electric car maker to neutral. The Nasdaq ended its 8-week winning streak last week after Federal Reserve Chairman Jerome Powell signaled that more interest rate hikes could be ahead. Today, it's difficult for traders to understand whether to buy or sell, so the indexes have support in both camps. Uncertainty was added by the beginning of the last week of the second quarter on a Monday, which caused profit-taking a few weeks before the start of the new financial reporting season. The growth leader was the energy sector, which rose by 2.2% on the back of rising oil prices. Among individual stocks, Pfizer shares fell by 3.7% after the drug maker said it was halting development of an experimental drug for obesity and diabetes due to the elevated levels of liver enzymes in patients in clinical trials. Lucid Group shares grew by 1.5% after a deal with Britain's Aston Martin would see the electric car maker take a 3.7% stake in the company. PacWest shares climbed by 4% after private equity firm Ares Management said it had purchased a $3.5 billion portfolio of specialty financial loans from a lender. S&P 500 and Nasdaq futures went up on Tuesday ahead of economic data, while a profit warning from Walgreens Boots went on the Dow. Shares of Walgreens Boots stumbled by 7.1% in a pre-market trading as they lowered their fiscal year earnings forecast due to lower demand for tests and vaccines and lower consumer spending. However, gains in mega-cap stocks such as Amazon, Tesla and Nvidia supported market sentiment. US-listed shares of Chinese firms such as Alibaba Group and JD.com surged after Chinese Premier Li Qiang announced stimulus plans and said economic growth in the second quarter would be stronger than in the first. The premier said that China's growth accelerated in the second quarter to a target level of 5% and that the government will take steps to increase demand, revive markets and boost the transition to a green economy. At the same time, central banks meeting at the ECB's annual forum in Portugal continued to put pressure on the risk-on mood. It's unlikely that in the near future the central bank will be able to say with a full confidence that the peak rates have been reached. ECB President Christine Lagarde said, adding that inflation is in a new phase that could be delayed for some time. Lagarde heard International Monetary Fund Deputy Governor Gita Gopinath, who at the same event on a late Monday highlighted the unpleasant truth about inflation, which meant that central banks needed to work harder to bring price increases back to the target, even at the obvious cost of economic growth. While these comments are likely directed more at European policymakers, where disinflation is lagging behind, markets also still expect the Fed to announce at least one more rate hike next month. Powell is due to speak at a conference on Wednesday. Economists at Morgan Stanley said they now expect the Fed to raise its funds rate in July to a mid-5.375% rate, where it will remain at least until the end of the year, with the further moves beyond July depending on the data. As for the economic calendar, the main focus today is the survey of the consumer confidence for June, which will be released after the opening bell. In the meantime, macroeconomics has pointed a firmly stable picture of the year's sentiment. New orders for durable goods jumped by 1.7% after rising by 1.2% in May. At the same time, the market predicted a decline of 1%. In fact, orders are up for the third month in a row, driven by 3.9% increase in net transport orders. Excluding defense, new orders rose by 3%. In addition, the number of building permits in the US increased by 79,000. Prior to the release of the fresh statistics, traders predicted a 77% chance that the Fed would raise interest rate by 25 basis points to a range of 5.25 and 5.50% at its meeting in July. Importantly, the macroeconomic picture will be supplemented later by data on consumer confidence. In terms of individual stocks, Snowflake grew by 3.5% after the company announced a partnership with NVIDIA that will allow customers to build artificial intelligence models using their own data. Alphabet shares slipped by 0.7% after Bernstein downgraded the stock to market yield. Whereas Wall Street depends on the economic data and high-tech stocks, the currency market is sensitive to the ECB summit. The hawkish rhetoric shared by central banks in Europe is bearish for the US dollar. Having shed 0.36% intraday, the index declined to 102.30. It's trading today within the corridor between 102.10 and 102.70. The forum in Portugal encouraged the euro further rally. At the same time of recording this video, the euro-dollar pair has grown by 0.6%. The leaders of the central banks confirmed the hawkish rhetoric. Latvia's central bank governor and ECB spokesman Martin Kazuk said on a Tuesday that the central bank is likely to continue raising interest rates after July. ECB President Christine Lagarde also spoke in a Sintra on Tuesday, saying that policy must be adopted from a meeting to meeting and must remain data-driven. At the same time, not everything is so bad for the dollar index. It was able to strengthen against the yen amid mixed reports about the prospects of moving away from the Bank of Japan's ultra-loose policy and statements that such steps may not be taken until autumn. In addition, today the index may still receive support from data on the consumer confidence in the United States. Already on Wednesday, Fed Chairman Jerome Powell, Governor of the Bank of England Andrew Bailey, and Governor of the Bank of Japan Kazuo Ueda due to speak at the panel with Christine Lagarde. The Canadian dollar is losing its confidence. Apart from the oil prices and the US dollar index, the loonie is digesting fresh inflation data. The USD card pair grew by 0.14% intraday to trade at 1.3170. The instrument is likely to trade in the intraday corridor between 1.3140 and 1.3210. The fresh inflation data cooled down expectations of a further rate hike in Canada because of any inflationary pressure. Canada's annual inflation rate declined to 3.4% in May from a 4.4% in the previous months. This is the lowest level since June 2021, which is in line with the consensus. The slowdown was largely due to a 2.4% decline in energy prices, due to an 18.3% fall in gasoline prices. The result was broadly in line with the central bank's case of inflation slowing to 3% by summer, raising doubts about the scale of the rate hike as a part of a new milestone in the tightening campaign. On the other hand, high interest from the Bank of Canada provoked the sharpest increase in the mortgage interest rates in history, 29.9% against 28.5%. Core inflation in Canada, which excludes food and energy prices, slowed to 3.7% in May from a 4.1% in April, below the consensus of 3.9%. Note that prior to the release of the data, market participants saw about 65% chance that the Bank of Canada would raise its benchmark interest rate at its meeting in July. However, the fresh CPIs could dampen the hawkish outlook. As for oil quotes, today they are not helpful for the loonie. Brent crude futures lost 1.1% intraday and fell to $73.30 per barrel. American WTI lost 1.2% and traded at $68.49. As for the cryptocurrency market, it's mostly optimistic today. Bitcoin gained ground in midday on Tuesday and was able to rise to 30,700. However, it could not resist. At the time of recording this video, the token was trading near the $30,500 high, or 1.3% higher. As for the top altcoins, they grew in sync, with the exception of Binance. Ethereum, Solana, Ripple, Cardano, and Litecoin fluctuated between 0.9% and 2.5% gains. The hype around Bitcoin ETF funds has been extinguished by market pessimism created by the confrontation between the Securities and Exchange Commission, Binance, and Coinbase. Over the past 12 days, Bitcoin has appreciated by 20%, lifting the overall market sentiment. BlackRock filed for a Bitcoin spot ETF on June 15, despite a past history of rejections by the Commission. According to CoinMarketCap, Bitcoin market value now represents nearly half of the $1.1 trillion total crypto market and the highest share in over 2 years. The use of the ETF filing proves acceptance and interest from the world's top players, which is, of course, interesting to institutional investors and retail traders. Following the filing, BlackRock, Invesco, and WisdomTree also reapplied for spot Bitcoin ETFs after the previous applications were rejected by the regulator. And this news helped Bitcoin out of its doldrums. At the same time, the asset could not climb above $31,000. The intraday range of the asset's movement remains within the borders of $29,700 to $30,800. An exit from the range can lead the crypto either to a new rally or to a correction below $29,000. Thank you for watching. We closely monitor the markets and provide you with the up-to-date financial information and analysis. We are waiting for your questions and comments down below. Subscribe to our channel and see you online tomorrow.